Most people, once they get to the age of 50 or 60, start thinking, do I have enough money saved for my retirement? Is it too late to save enough? And you might have a reason to worry because superannuation in Australia, which is our best form of saving for retirement, is filled with rules, regulations, and contribution limits. But I might have some great news for you today. I would like to explain a little known contribution opportunity that might help you, number one, to catch up on all those lost years of not contributing enough. Number two, grow your super and ultimately retire better. And number three, get tax benefits in the form of tax deduction for your contributions. If we haven't met before, my name is Katherine from About Retirement. I'm a certified financial planner and I have been helping my clients for over 20 years with creative strategies to improve their savings, super, to create great investment portfolios which ultimately provide secure retirement with great level of income for life. And today I really would like to help you as well. So today we are talking about the requested topic, carry forward super contributions, otherwise known as superannuation catch-up concessional contributions. And I will cover, number one, what are carried forward contributions? Number two, who can benefit from carry forward contributions? Number three, what are eligibility rules? Number four, some case studies for you. And number five, 4 steps to do it right. But first, let's review very quickly what concessional contributions actually are. Those are your deductible contributions, so contributions for which someone claims tax deductions when money is being contributed to superannuation. And that includes superannuation guarantee contributions, or SGC, which are your employer contributions, and obviously that's your employer who is eligible for tax deduction. Your salary sacrifice contributions, if you are self-employed, all your self-employed contributions for which you wish to claim tax deduction. Or even right now, a private person, you don't have to be self-employed anymore, but a private person can contribute to super and still claim tax deduction. But we all need to play by the rules. The annual limit of this type of contribution is $25,000. Well, I'm assuming that you have checked that you are actually eligible to contribute to super in the first place. If unsure, have a look at this video. If you need to get familiar with superannuation contribution rules, including SG contribution, have a look at this video. If you would like to understand benefits of salary sacrifice, here is another video for you. And now let's dive into this. What are carry forward contributions? Carry forward contributions, so-called catch-up contributions, or as the proper industry naming is, carry forward unused concessional contributions, are not any special type of contributions really. They are often overlooked contribution opportunity, allowing you to contribute to your superannuation fund the amount of concessional contributions that you have not used in your previous years. You can only contribute up to concessional contribution limit and up to 5 years. After 5 years, any unused amount expires. But it all started in the financial year 2018-19. This means that the first year you were able to make additional concessional contributions by applying any unused concessional contribution cap was in 2019-20. So bottom line, what that means is that if, for example, in 2018-19 financial year, only $10,000 was contributed to your super fund as a concessional contribution, and as we know the limit is $25,000, you actually have $15,000 remaining from that year as unused concessional contribution that you could carry forward and use it to increase your concessional cap until 2023-24 financial year. So who can benefit from carry forward contributions? Well, virtually anyone can benefit from those types of contributions, but it's especially beneficial for self-employed people where your income can vary from year to year, or any person whose income varies due to commissions, bonuses, or part-time employment. It is also a great way to contribute extra to your super at a later stage in your life when kids are off your hands, you have mortgage paid off, and you have a little bit extra of disposable income. So what are the eligibility rules? Well, number one, you have to be eligible to contribute to super in the first place. Number two, as we said before, annual limit is $25,000 per financial year. Number three, your total superannuation balance must be under $500,000 at 30th June in a previous financial year. So if you are thinking to make a carry forward concessional contribution in 2020-21, your total superannuation balance must have been under $500,000 on 30th June 2020. And don't forget that your total super balance is a superannuation balance of all your super funds. And that includes your accumulation phase and your retirement phase, as well as any rollovers in transit between super funds on 30th of June. Also, it is important to remember that if your total super balance falls below $500,000 at a later date, for example, due to market fall, you are once again eligible to apply any of your unused concessional contribution cap in future financial years. The $500,000 total superannuation balance is not subject to indexation. It is really designed for people who had no time or sufficient funds to grow their super fund to reasonable limits. So let's have a look at some case studies now. My client Patricia took time off work in 2019-20 to complete her study. Her super fund balance on 30th of June 2020 was $150,000. Following year 2020-21, when she returned to work, she was able to contribute $50,000 to superannuation as concessional contribution. So those contributions before tax for which you can claim tax deduction. So that's $25,000 for 2020-21 and carry forward unused concessional contribution of another $25,000 for financial year 2019-20 when she was not working. So now let's have a look at Tom. Tom is 50 years of age with annual salary of $120,000 and super balance of $180,000 on 30th of June 2020. This is the very first time when he's on such a high salary and he's quite aware of poor superannuation balance. We checked with his super fund all concessional contributions made in prior years. In 2018-19, there was $5,000 contributed as concessional contribution. As we know, the limit for the financial year is $25,000. Less $5,000 contributed, it leaves $20,000 of unused concessional contribution for that particular financial year. In 2019-20, there was $10,000 contributed as concessional contribution. We have $15,000 remaining as unused concessional contribution. So in 2020-21, he could contribute up to $60,000 of concessional contribution. That constitutes of $25,000 for 2020-21, $20,000 for 2018-19, and $15,000 for financial year 2019-20. Altogether, $60,000. The entire $60,000 is concessional contribution for which he can claim tax deduction, but don't forget that that contribution will be taxed at 15% on entry to superannuation fund. And now let's have a look at Ruby. She is planning to use some of her unused concessional contribution cap amount to make a concessional contribution on the top of her employer SG contribution of $5,000 per annum. So let's assume that on 30th of June 2021, Ruby's total super balance is $200,000. Ruby's unused concessional contributions amounts from previous financial years are as follows. In a year 2018-19, we know the cap was $25,000, $5,000 was contributed by employer, leaves $20,000 of unused concessional contribution available. The same applies for the financial year 2019-20, 2021, 2021-22, assuming that employer will contribute the same $5,000. So the total amount Ruby could contribute as a concessional in 2021-22 is $80,000 after excluding employer contributions of $5,000 for that financial year. Now, Ruby decides to contribute $50,000. She is eligible to claim tax deduction for the full contribution amount, and her super contribution will be taxed at 15% on entry to superannuation fund. As Ruby hasn't used up the full amount of unused concessional contributions, there will be $30,000 still remaining as unused concessional contribution for following years. This is because catch-up contributions work from the earliest year to the most recent year. So by contributing $50,000, Ruby is left with unused concessional contribution of $10,000 for 2020-21 and further $20,000 for the financial year 2021-22. So now let's have a look at those 4 steps to calculating your carry forward amount. Number 1, contact every single superannuation fund if you have many. Don't forget that pension is also included, to find out your total superannuation balance. Step number 2, ensure that your total super balance is under $500,000. Number 3, check your concessional contributions for previous years and compare with the contribution cap applied for that particular year. Number 4, work out the amount you have available to carry forward from unused concessional cap. Some super funds will actually list that information on your contribution statement. As with anything related to superannuation, the rules are complex. There are a lot of conditions that you need to apply because this is a concessionally taxed environment and it is governed by Australia's superannuation law. But there is a great deal of benefit to this strategy. Number 1, you can utilize otherwise unapplied unused concessional contribution caps. Number 2, you have ability to increase amounts held in your superannuation. Number 3, it is potential to increase tax deduction for your personal contributions beyond the standard $25,000 cap. And number 4, you have ability to move deduction for personal contribution to later financial years, which may actually suit you. It might be better timing because, for example, you expect a higher taxable income, or you might be subject to capital gains tax. This is a fantastic tax strategy in a year when you dispose of some major asset, such as, for example, investment property or bunch of shares. The extra unused concessional contributions can work wonders for reducing your personal tax liability, your capital gains tax, when you are preparing your income tax return. Please make sure that you triple check your personal contribution limit for the year, and you will understand super contribution caps and not contribute above the allowable limit to superannuation fund, as you will find yourself in a little bit of debacle of excess contributions for which you will be fined a penalty. If you found this video of value, please like it and subscribe to my channel to be notified of my new videos. If you have any questions or comments, feel free to leave them below my video. Superannuation is a very big and complex topic, so to make sure you are doing everything correctly, view this series of videos explaining all you need to know about super. The second video is how to choose the most suitable superannuation for you. Thank you again for joining me, and I hope to see you here soon.